Before we begin, please note that this video contains AI-generated visualizations, is strictly for educational purposes, and is not financial advice. A lot of retail investors look at utility companies hoping to find a stock that doubles overnight. If you buy expecting a quick payout, you will likely be disappointed. What we are really looking at here is a slow, steady, long-term compounding story. For decades, the baseline of this company was heavy traditional power generation. They currently operate roughly 8.9 gigawatts of thermal energy capacity, largely dependent on legacy fossil fuels. But they are actively diverting capital away from that fossil fuel baseline. The core investment thesis relies entirely on this transition. By systematically replacing coal with clean energy, the company positions itself to trigger a valuation re-rating. Markets simply pay a higher premium for green energy earnings than they do for legacy thermal output. This chart shows the realistic expectation for investors who hold through the transition. Rather than a jagged, speculative spike, a successful execution of their green pipeline mathematically points toward a steady 12 to 18% compound annual growth rate over the long haul. As profits from renewables compound and get reinvested over the next 10 to 15 years, the market stops viewing them as an old, heavy industry power utility and starts pricing them as a clean energy leader. To execute that shift, Tata Power is feeding their immediate growth engine, a massive expansion into solar and wind. This 3D breakdown visualizes their portfolio. Right now, they have 16.3 gigawatts of operational capacity, but look at the pipeline. When under-construction projects come online, total capacity expands to 26.3 gigawatts. The clean segment physically overtakes legacy assets, accounting for roughly 66%. Beyond the utility-scale solar farms and wind turbines, a secondary revenue stream is scaling up quietly, the national rollout of their electric vehicle charging network. They have already deployed more than 190,000 home chargers across India, alongside over 5,700 public charging stations. By securing these physical locations early, they lock in a recurring revenue model. Every time an EV plugs in, Tata Power collects a fee, operating much like traditional fuel stations, but with high digital scalability. Together, these renewable projects and the EV ecosystem form Engine 1. They generate the stable cash flows and attract the ESG-driven investor capital required to fund the company's capital-heavy, future-focused ambitions. Which brings us to Engine 2. Their strategy for the next 7 to 15 years. Tata Power is actively exploring small modular reactors, or SMRs, specifically in the 20 to 50 megawatt range. Traditional nuclear plants take a decade to build and require massive land and capital. SMRs cost significantly less, can be manufactured in a factory, and deploy faster, making them highly effective for localized industrial energy use. The trigger for this expansion is a recent policy shift. Historically, the Indian government maintained a strict monopoly on nuclear operations. They have now opened the sector to private companies. This bar chart illustrates the reason behind that policy shift. India plans to increase its total nuclear capacity by a factor of 10, targeting roughly 100 gigawatts by the year 2047. Tata Power won't generate revenue from nuclear tomorrow. The land acquisition and licensing phases are still pending. But by positioning themselves early, they are securing a foothold in a high-margin baseload power source that can stabilize the grid when the sun isn't shining and the wind isn't blowing. Before making any moves, we have to weigh that long-term potential against the actual execution risks that we face. Transforming a legacy utility into a dual-engine clean energy provider carries significant friction. As more players enter the solar and wind space, renewable profit margins can shrink. Large-scale utility projects routinely face execution delays, and the final government regulations for private nuclear development are still unwritten. Because of these variables, you should not view this asset as a perfectly safe, bond-like stock with guaranteed dividends. It is a controlled risk, growth-oriented execution story. If you try to trade aggressively in and out of the stock, or buy in heavily right after a sudden market rally, you expose your portfolio to severe downside when market sentiment inevitably cools. The math favors a systematic approach. Using a staggered buying strategy or a systematic investment plan allows you to accumulate shares gradually during market dips. You build your position while sentiment is weak, rather than paying a premium when it's strong. By measuring your holding period in years, not months, you let the compounding effect do the heavy lifting. You align your capital directly with the physical, multi-decade build-out of India's future energy grid.